No.
Hey, everybody.
Come on. Go.
Welcome.
Let me go.
Welcome to week 138 of this crazy train. And Adam had to answer the door, and we heard all about it. So, hey, if you weren't watching and weren't paying attention, the USA beat Iran the other day in this soccer match, and it was a high-scoring game of 1-0, but it was exciting. So it's funny because now all of a sudden we got a whole lot of soccer fans out there, which is great. So anyway, they play again on Saturday morning, I think 10 o'clock, right? Something like that. So we've got all kinds of stuff ready for you. Oh man, I better hit this chat again because Papa Joe, just in case. All right, oh yeah, it's enabled. Something has changed. That's awesome. Okay, so Papa Joe, be happy. We are going to talk about year-end planning. We're also going to talk a little bit about whatever you guys want to talk about on this rail strike if you want. And there's some changes to the tax code. We had a lot of fears, I guess, and saber rattling early in the year. Some of that stuff's been tamped down, but there are some changes that are going to come. So Adam, you might want to talk a little bit about that. And Jack, do you have some other current events that you need to bring us up to speed before we go into it? And you guys know the drill. Hit us up with Q&A. You can harass us on the chat.
Yeah, sure. So good morning to everyone. It was a glorious game, even though if you don't understand soccer, then you're like, okay, 1-0, no big deal. But if you understand soccer and you were watching the last 10 minutes of that game, my heartbeat is raising right now, just thinking about it. So 10 a.m. against the Netherlands on Saturday morning. So I wanted to share, there was an article that I found, I think it was a Wall Street Journal article, was republished in the Business Journal, Charlotte Business Journal, about companies returning to work and some statistics. As you guys know, I like my numbers. So I'm going to provide some statistical information on kind of what's going on. This was published a few days ago. So the numbers are 15% of workers are still remote full-time, while another 30% are working in hybrid arrangements, according to new federal data. And that translates to 60 million hours in commute time saved. And workers are using that time for leisure activities, sleeping, and even working more. 35% of, so how are they spending their time essentially, or their extra time? Well, some recaptured commuting time to work, so that's the biggest benefit, but they substituted other activities during the day, making the commute a flashpoint in the return to office debate. So this article really was, okay, what is going to be those kind of points as between employer and employee that are going to make a difference, or is going to influence someone's decision whether to keep a job, take a job, or push for working from home. And so this article is basically saying that people have gotten used to not spending so much time in their car, and so that is going to be a big factor. And then they said they kind of separated out the younger Americans versus older Americans, and so the younger Americans use their recaptured commute times for leisure activities, such as social events, dining at restaurants, or exercise. And then the older workers devoted more time to childcare, household maintenance, and meal preparation. I thoroughly disagree with that, because my meal preparation, when something says it's going to take 20 minutes, it takes me 5 times as long, because apparently I chop my parsley and other vegetables and other ingredients too finely, and I should just chop them up and put them in there and it's all good. So apparently that is the feedback that I've received from my family when they haven't been fed by 7 p.m. on a given night, when they know I've been cooking since about 5:30 p.m. So and then this article goes into other things and other factors, but I thought I would share that. And then in other news, I saw an article that the SBA is finally going to distribute about 83 million in unused restaurant revitalization fund grant money to business owners. This is they aren't not reopening the application process. They're basically picking up where they left off. So they ran out of money in their initial tranche of money, and so they had this other money that was set aside for various reasons, potentially litigation in relation to the distribution and the selection of the those recipients. And so they know who it's going to go to. And they said 169 business owners with pending applications. And those people have been waiting for many months. So if you are one of those people, great news, you hopefully will be getting that money soon. It's only 169. So statistically, unlikely that there is one or that there is more than one, if any, in this group that views this, but just in case, that's kind of good news that the money is going out into the economy in general. So those are kind of the two updates that I have for this week.
Cool. And remember, 10 o'clock a.m. Saturday morning.
Sorry.
That's all right. Hey, speaking of Adam Boatsman, so you want to give us kind of a recap on some of the stuff from a tax standpoint people should be aware of, changes that are coming, stuff that they should be doing now before they get into holiday cheer?
Yeah, I appreciate that, Gary. So sneeze is always coming 3 for me, so there's a chance there's 2 more that are on their way. So the for starters, just 2 kind of general things before I get into the tax planning side of the equation, and one of them I'd ask Jack just to hear his opinion on, because his opinion is not relevant on the other. I'm just kidding, it would be relevant on the other. So the first thing that I'll hit on for Jack's opinion that I've seen more and more out there, banks are getting crotchety. They're doing their covenant testing right now, and covenants meaning like if you have to have so much net income relative to your debt, your balance sheet ratios, like equity to debt or funded debt to income. They're getting crotchety and asking a bunch of questions. And my feeling is that they are getting pressured from above to just start identify where they having problems coming into next year. So I mean, like if you're counting on your friendly neighborhood banker to be Mr. Renewal and Mr. Credit line increase, because that would be perfectly logical, because I'm a good human, and I think that I'm going to be doing better next year because I feel like I'm going to be up. I don't know if you could ever pull that off in the past, but I feel like do not count on that in 2023. From what we're seeing. From what we're seeing is, be buttoned up a lot, forecast, projections, support your need. If you're taking cash out of the company to fund your distributions, make sure it ain't the banks. Have a good story around retained earnings, working capital, and how much the business really needs to operate. Because there's more screw. There's been, again, this is in the last week, and as I said, it's like these are good clients that we have good relationships with the banks that they're working with, and at the same time, it's like, well, damn, like who invited special assets group onto the call? I mean, it wasn't actually the special assets person on the call, but it sure freaking felt like it, based on the nature of the questions that were being asked and you can just kind of tell from the tone of somebody's voice. It's like, the way that I asked the question, it's implied that Gary's screwing me, versus the nature of the question and my tone of voice. I'm actually really just curious, and trying to answer a question because I'm generally rooting for you and excited for you. It was definitely the former, not the latter. So Jack, I'd be curious to, see if you kind of heard anything or seen anything and, the transactions and stuff that you're working on.
Sure. So there's this concept, and you're not going to find it in a statute. It's a beast of kind of case law and interpretation of contracts, but it's an old kind of I shouldn't say theory, but just part of a contract. And if you look carefully into your contracts, including your loan agreements, you're going to find this concept called anticipatory breach. And what that allows a lender or whoever the other party is, if they feel insecure or believe there might be problems, then they can, in the worst case scenario, call the loan or say, we need to make some modifications. And so a lot of times it is, they have some sort of indication, or they will go through just their process, end of year process, beginning of the following year process with loans, and do the testing as Adam has described, and with the covenant ratios and all those things. And so banks tend to just normally get a little more aggressive towards the end of the year, because they have had, they have reporting requirements by year end, assuming that they're on a calendar fiscal year rather than some other fiscal year. So let's assume that, it's 12/31, and that they will be looking to find and see if things are different than they were, hopefully better than they were in the past 2 years of COVID. But if there's a trend in the other direction, then they get nervous. And so and again, I don't have any particular insight into, having a discussion with Brian Moynihan or anything like that, but I would assume that the word is, or the orders are, to make sure that we feel good about where our position is, our risk is, which may be different than it was at the beginning of the year for whatever reason. And again, hoping that the risk is less, but it also informs their ability to lend in the subsequent year. So if, let's say that their risk tolerance pie is like this, and it has shrunk a little bit, then that gives them extra capacity to lend out, and maybe lend out on riskier, and you would never hear a banker say that word, lend out on a transaction that maybe is a little more risk adverse to the general position of the bank. So all those things go into this. That's a long-winded way of saying yes. I kind of expected it a little bit, but I think that they are being aggressive. And so Adam's point of, and what we've said from probably the very beginning weeks of when we're talking about PPP stuff, is documentation, have your stuff in a row, be ready to present it. So if you have a loan document that says you need to maintain these certain ratios, then have the calculations done and say, okay, just and give it to them and show them that you're being assertive and that you know what's going on with your lending facility, so that if nothing else, psychologically, it gives them some confidence, and that you are doing well and doing what you're supposed to do and paying attention to what's going on in your business, rather than saying, well, here's the stuff, bank, figure it out. Let me know if we're not in compliance and then we'll fix it. So.
Yeah, no, I appreciate that. It definitely, going back to your, hey, the order thing, it's like, it feels like the order of the day is, boys, we're headed for a recession. Everybody's going to screw us. Get out there and be defensive, about it. It's like the standing general order of the day, right now. So it's just, it's something that I observed. But yeah, so to answer the other question, Gary, with respect to, taxes and year-end planning, kind of the will it impact people really materially or not? One way or the other, probably not, but the kind of the biggest material change going from 2022 to 2023 in the tax code is that bonus depreciation, which is the ability to expense things 100% when you purchase it for newer used equipment, is dropping to 80% next year. So you still get the other 20%, you just get it spread over the useful life of the equipment. So point being in that is that, look, I mean, in prior years, if you're going to buy it in January anyway, or February, you can accelerate to December. Maybe that means something to you, maybe it doesn't, in terms of like where your taxable income's at. But now it's like that actually kind of matters a little bit more, such that if you wait, you will not get the full benefit via bonus depreciation. I'm not going to get into like, well, because you could still section 179 it, but anyway, it's just something to consider in your asset purchase decisions, that if you had typically been somewhat ambivalent in years prior, just understand that you're going to be foregoing some benefit if you procrastinate or put it off until early 2023 when you could have pulled it back to 2022. So that's the biggest change. I think on the other side of the equation, in terms of like, well, hey, what's not changing? We've said it on a few calls. It's funny, wife and I had a dinner last night at Epic Shop House. Ran into a client there that was having dinner, who's, I just checked, is not on this call. Probably won't be listening to the webinar either. But he's like, yeah, Biden and these taxes, and I just, I did not feel the need to correct him, because I love him, to say, first off, Biden hasn't changed your taxes. Secondly, the odds of Biden changing your taxes right now are freaking zero. Like, if it was possible to actually be less than zero, I would put less than zero on it. But I mean, it's just a reminder that don't fear a tax rate increase. Again, I could be eating my shoe later on down the road, but it would require the House, who appears like it's fully headed for a complete train wreck of gridlock, to pass a tax rate increase. And I just, I haven't looked it up to find out when the last time a Republican majority passed a tax rate increase, but I suspect it was under, actually no, because Tip O'Neill would have been the Speaker of the House under George H.W. Bush. So it predates the 90s, baby. So I think that, for all intents and purposes, tax rate increases on the horizon, probably not until January 2026. Not even, maybe under a new administration in 2024, if that happens, or 2025 when it would actually happen, but most likely January 2026 when the American Tax Cuts and Jobs Act expires, which would be, probably estate tax deductions would significantly change. And on the ordinary income tax rate side of the equation, most of our clients would have about a 10% increase overnight if that happens. So I don't see a ton to worry or fret about on that. So it kind of gets back to routine tax planning, which I'm happy to go in at some point, Gary, unless you want to steer us in a different direction.
Yeah, no, I think that's important. But we did get a question in from John. And the question is, S-179 is still around for 2023 onward, as far as we know, right?
For everybody but you and Jack, John, it is. But you and Jack, they wrote out a special rule in the tax code saying you don't qualify. I'm just kidding. Yeah, Section 179 is still around, and that the limitations on that were made permanent. So, permanent, as much as permanent anything can be permanent, but those are permanent. So that should not be going away in terms of the method and the existing dollar amount. So.
All right, awesome. Yeah, let's go into some stuff like cleaning house, things that you should do so you don't have regrets. Oh man, I didn't do this, and it's 1/1/2023 now.
Yeah, so let's go with the stupid tax items. And by stupid tax, I mean like, oh yeah, I totally should have done that, but I didn't do it. What can I do about it? Some cases, nothing. In other cases, well, you could do something, but it's gonna, it's not optimal. So first and foremost, and this applies primarily to owners of S corporations, looking at your W-2 wage relative to your distributions and your bottom line, net income flow through, tax court would tell you that, anywhere between 20 and 30%, as long, in other words, if the company made 100 grand before you took a W-2 as an S corporation owner, tax court cases that have been won by the taxpayer, so not won by the IRS, Gary, won by the taxpayer, 30 grand W-2, 70 grand distribution, that's one. That's on the aggressive side, but it's one. But out of the gate, most people say, oh, just set your wage at, 50-50, or it's got to be reasonable. So at the upper end of the spectrum, unless it's to fund a supercharged retirement plan, Social Security limit, which this year is, I think, about $150,000 in round numbers. The max for pension profit sharing plan is 305 this year. So my point in saying that is zero reason, unless like there's performance-based compensation that doesn't tie in with S corporation ownership, there's zero freaking reason that we should ever have any S corporation owner client that takes a W-2 greater than $305,000. And that's only if they're funding a retirement account to its fullest extent possible, which means profit sharing component. Most of the time, it should never be above $150,000. And that's going to be income, like bottom line driven. So if you think about it, back in my rule of thumb, it's like, look, if I had about 600, when do I reach that limit? Bumping up against, five. Haven't done the equation, but round numbers, I'd say it's probably around pre-W-2, about 600 grand in income. You probably got to take about 150, take the rest of distributions, and you're going to pass an audit every single time with flying colors on that. Otherwise, I'll eat my shoe, Gary. So what is that costing you? Well, with the Tax Cuts and Jobs Act on distributions, you're only paying 80 cents on the dollar, plus you're avoiding Social Security taxes. So that same scenario where someone's taking, 300 grand, but should only be taking 150, actually about $16,000 permanently that cost you to do that. That's just kooky dukes. And as many times as I say it, you would not believe the number of times that we find it with a first-year client that they've left that money on the table. So that's item number one. Related to wage, item number two, stupid tax, would be funding your own retirement account. That, like, if you got the cash laying around, I mean, I could get into esoteric arguments around, well, what will the stock market do relative to tax rates? So those are all true arguments. It's just that, look, that's a layup. So fund your own freaking retirement account before the end of the year. That's item number two. And, you could accrue it and then pay it in the next year, but, make sure it happens and is reflected correctly in your W-2 before the end of the year. And if you've already overtaken your W-2, you can get some payroll tax returns amended, if you needed to before they're due to get that fixed. Like, it's not too late. Once the W-2 is issued, though, it's a little bit more difficult to get it changed. You can do it, it's just not advisable. That's item number two. Item number three are the other way ups. Like, if you're a cash basis taxpayer, meaning you only pay taxes on money that you collect and get a deduction for bills that you pay, not actually paying down the bills, another force error. It doesn't need to happen. Even if those bills are paid December 31st, pay them down. So those are kind of my big three stupid tax items, meaning like you paid a tax you did not have to pay. I mean, everything else is sort of debatable. Hey, you didn't know any better. I mean, these are kind of like the three you should have known better, and we can't do anything about it, fix it type things. I mean, everything else is correctable after the year. Those are items that are not correctable. Besides also buying stuff and getting bonus depreciation. Those are items that are not correctable after the end of the year.
So let's talk about that just briefly, Adam, because a lot of times we hear, hey, I had a windfall this year. Should I buy more equipment? Should I lease it? Especially equipment or trucks, vehicles, right? So I know we get a lot of questions about that. You want to weigh in again on that? I know we've talked about it, but I think
Yeah,
it's
so
worth
in
doing.
years prior, I would have said, it could be, but at the same time, you're at the lowest tax rate possible. So, if you're kind of iffy on whether or not you need it or not, it's kind of, I don't know, it's kind of, if you do it this year versus you do it next year, it's more of a time value money question, may not matter as much. Now it matters because going into next year, you will lose 20% of the immediate deduction. So you should buy the stuff this year. If that's part of your tax planning strategy versus putting it off until the first quarter of next year. All that said, the only time I would amend that would be like, if you are starting to feel the effects of a potential recession, it's always nice to be able to give the equipment back. So that would be the scenario where I consider an operating lease, even if it's more expensive and I don't get the full benefit of the depreciation, depending on the nature of the lease.
Robert Mayetta is on. It's so good to see you weighing in with another question. We kind of missed you a couple times, so it's good to see you. So here's a question from Robert. Are meal expenses only 50% deductible for tax, but company events are at 100%? It's a question. This is the way it was before COVID, but there was a change for a year or two, correct?
Yeah, that's a true statement. So part of the COVID relief package, they said that meals and entertainment were 100% deductible. So that's what's in effect now. That changes next year, I believe, back to the original rules. The other thing that changed too is they said that entertainment is not deductible, meaning like, hey Gary, you're an awesome customer, here are my Panthers tickets, you go ahead and take them. However, same set of facts. Hey Gary, I want to meet you on breakfast on Sunday to go over that acquisition that you're about to do. And by the way, after that, here are my Panthers tickets, go have fun at the game. Deductible because I had a business meeting proximate to the entertainment. So just not all entertainment is created equal. Try to have a business meeting proximate to it, which there's no bright line on what's proximate, but generally speaking, tax courts have said it needs to be within a day or two, not like months. Hey, I talked to Jack like 6 months ago. Here are your Panthers tickets. That's proximate. No, that's not going to pass.
What if you make the promise within a few days, but it's not delivered until down the road?
That is not going to work either. Meaning,
Okay.
in other words, if you make it a couple days around the road, that's okay. But if you don't, and it's like 2 weeks down the road, that's not going to be okay.
So you're saying if someone promised me 2026 World Cup tickets today,
you're out. That's
I'm
out,
out.
buddy.
Okay.
Yeah, you're
Just
out.
checking.
Yeah, you're out. Sorry, buddy.
You got soccer on the mind. Good questions so far. Any other questions from the gallery? You got to have stuff. I'm looking at this list of all these smart people on there, and you're on here pretty faithfully. You guys are a list of the usual suspects, which we appreciate you being on here. We really do. But stump the chumps on this one. Hit them up with a question like Jack just did. We won't make you feel stupid.
So I'm going to provide some free legal advice because today is a very special day in the state of North Carolina for North Carolina businesses that have assumed names. So all y'all who have DBAs, and the date is, let me refresh my recollection. So businesses that registered an assumed name prior to December 1st, 2017. So 5 years, beyond 5 years ago, need to go onto this central database on the North Carolina Secretary of State's website and re-register that DBA. if you've registered a DBA, you know anything about it, it was originally done in the county of your principal business or where you had a significant presence, at least in the state of North Carolina. And they're trying to create a central database. So they established this in 2017, and they said, okay, you have 5 years to get it together, and today is the day. So we have one of my colleagues, Andrew, who has been on here, the IRS agent, former IRS agent, published an article, and I'll grab the link in a moment and put it in the chat for everyone to see where you need to go to do this. But yes, if you have a DBA that was filed prior to December 1st, 2017, you need to do something in order to maintain that DBA. Now, they're not specific as to what the penalties are. And the whole concept of a DBA is so that if I want to sue somebody and I see ABC Bakery on the front door, but their legal name is not ABC Bakery, I need to be able to go to somewhere and find out what is the LLC name for ABC Bakery, and then list them as the defendant in my lawsuit. So that is the purpose for having that database. Some people will, if your name is readily apparent, meaning in your legal name, you don't have to file those things. If you are a franchisee, you typically have to file as XYZ LLC, doing business as physical therapy, the FYZ physical therapy franchisee. So of Lake Norman or Charlotte or whatever it may be. So anyway, I will post that here in just a second, but I was just reminded of that, it being December 1st. And so there you go. Sorry for the homework.
Can you believe it's December 1 already? Dang. We're almost coming up on 3 years of doing this. That's just so, I still am like amazed. I was running this morning and I haven't been inside the gym since March 13, 2020. And I really don't miss it. I mean, as long as I got pull-up bars and can run outside, but I was just thinking, man, I remember starting to do that routine, and well, hopefully it'll be over in a couple weeks. Not really. So anyway, crazy. Adam, anything else, like from a business standpoint, planning, some of the like key planning things, because we're in the thick of planning right now with all of our clients again, and we do this throughout the year, but we're in strategic planning again to just tighten things up right now. Anything that seems to be a theme?
We hit on it a couple calls ago, but I'll go ahead and repeat it. I mean, where we always like to start is, and again, this doesn't matter if this isn't related to year-end planning at all. It's just basically coming up with what is your game plan. The levers that we typically pull is, let's look at owner fringe benefits first and just make sure we're taking advantage of the tax code, in terms of like, okay, if I was going to go sell the business tomorrow to Gary doesn't need that, but it is a deduction for the purpose of the tax code, so I should deduct it. So just kind of doing an inventory and making sure that, okay, yeah, we're fully taking advantage of, when I say advantage, that sounds so awful. It's like literally I'm doing what's legally allowable. That's kind of cut. That's always cut number one that people need to be focused on, because I mean, generally, I think without being diligent about it, and by diligent, I mean like literally, kind of understanding what's deductible and using your company card, where you can, so that it's already measured and accounted for. I mean, we generally see people leave, $10, $15, $20,000, per owner potentially on the table of fringe benefits they could have deducted, that they didn't. And I mean that, well, it's not that much money, Gary. I mean, it's still $3 freaking grand, on the low side of actual tax savings. so that's, that's one. I think the other one is if, once you kind of get into, super discretionary cash, meaning like I got a lot of money and I'm trying to do something with it. There are some other strategies out there that are time sensitive, like a syndicated conservation easement and stuff like that. So just, kind of make sure that, and I didn't double check the attendee list to see if these were all clients or not, but really making sure that you feel like, look, I know what my tax plan is, and I can go to bed at night knowing that I'm doing everything that I possibly could do given my cash flow. That's where you want to be at right now. And you want to do whatever it takes to kind of get there, to make sure that, okay, I know every strategy possible and I'm taking advantage of every one of them that's appropriate for me.
Good. So I don't know why, Jack, you couldn't share that to everyone in the chat, but I did. It's in the chat if you want to see that article. And if you do remember Andrew, Confessions of an IRS Agent, we've had him on a couple times. Those have been fun to kind of hear his take, and it's been a lot of fun. Question came in here from Bruce. For revenue received throughout 2022 from foreign sources in foreign currency, exchange rates, inflation have been a wild ride. In reporting this revenue at year end, is there any guidance you might provide? Good question.
Yeah, so basically, with foreign currency translation, you really got two components. One component is unrealized, gains or losses, and then the other is realized gains or losses. So the only one that's allowable from a tax reporting standpoint, Bruce, is the realized, gain or loss, and there's no magic answer on that in terms of how you calculate it. So I'm just going to tell you what we do at BGW. Because there's no absolute defined method of what you're supposed to do. So what we do is we take two looks. One is, look at the beginning of the year, look at the end of the year, what were the exchange rates, and where Bruce is going, where this typically applies is like, I issued a receivable in dollars, or sorry, I issued a receivable in foreign currency, and then I get paid back, and then I got to repatriate the money. And there's been an exchange rate issue that's occurred somewhere in the interim, and where you need to do some calculating would be where I haven't repatriated yet. So it's still sitting in a foreign currency, whether it's in the receivable or it's in cash in a foreign bank account. So what we do, Bruce, we take a look at beginning of the year, end of the year, what were the two exchange rates, what's the realized gain or loss in there, not a holding gain or loss, but the realized gain or loss, and that's amount number one. Let's say that's $100. Then the other way we look at it, since people are issuing, receivables all throughout the course of the year, we also look at it on a monthly basis, beginning of the month, ending of the month, take an average, that's the exchange rate for the month. I mean, you can get more scientific if you wanted to, but then we look at that method, and if that yields $200, we're going with the most advantageous, and just picking the method that yields the best result from a calculation standpoint. But either way, it's just an estimate of what your holding gain or loss is by keeping the receivable in a foreign currency. If you could calculate it on a daily basis, you would do that, but you can't. And the only other way to calculate it is to get paid and convert everything else to dollars.
Great question. Seemed like a logical answer, but that's outside of my wheelhouse. So that's why Adam's on.
Okay.
Any other questions from you guys? One thing I'm going to find for you guys is you need to put this on your calendar if you're as wise as I think you guys are. January the 11th. We're going to be doing the best year ever And if you are interested in doing that, we're doing that live. The last couple years, and Bruce says, this is helpful, confirms that there is no one single process. Thank you. You betcha. But best year ever, January 11. It's going to be from 11 until 1, it looks like, at BGW in the community room. So I think we can get up to 40 people in that. If you're interested in that, please let us know. I've done it now, I think 4 years, something like that. And it's amazing. I mean, it's just stinking amazing how powerful that is. And again, I think it'll be fun to do it in person versus Zoom. So, January 11, let me know, send me a text or email, or just send me an email, gfrey@trustbgw.com. And we'll make sure that you get on the list. So, Trey, good to see you here, man. Here's the question. How about college planning year-end thoughts for 2023? I know you're here too, Adam, but what should I be thinking about as my oldest one heads to college?
Yeah, good question, Trey. And I'm trying to remember who I ran into the other day that also knows you, and we had a good chuckle at your expense. It'll come to me. I'll text you and let you know. But
everybody knows Trey.
Yeah. So two things on that front. Number one, Trey, using you as a specific example. So hope you don't mind. But assuming that, Trey, you've done a good job of encouraging, and by encouraging, I mean telling your child that they need to go to your alma mater, App State. You got a condo in the immediate vicinity. And if it so happened that your kid lived in that condo, you could be getting a deduction for the expenses associated with that condo because you're now the landlord. So that's a long way of saying that a lot of our clients, when their kids go off to college, they buy a piece of real estate, have their kids be the tenant, pay themselves rent that gives them the benefit of deducting the expenses versus what the Boatsman family is doing, which is paying the freaking Cayo house that I'm not getting a deduction for. So it's just but if you've subsequently, and I have looked at Savannah for Jacob, if real estate ever became super attractive that they would live in and have some roommates in, it's like, oh yeah, I'm putting on that list to buy, so I can at least A, get a deduction for it, B, have an appreciated asset instead of, making some other slumlord rich. So that's one thing. The other thing too, this applies more if you're a business owner. We all think that our kids need to have a work ethic and, they ought to work for us. And, one school of thought that is subscribed to by one member of the Boatsman family household would be, there are children. They should do it because they want to contribute. The other side of the Boatsman household says, no, we should absolutely pay them because then they can use the money for college and we can get a deduction for paying them. Anywho, I found it funny that my own daughter posted an Instagram note that said, have your dad pay you so he can get a tax deduction for college. To which I responded with, that's really cool, Eva. What are you going to do for me? To which she gave me a frowny face emoji. But my point in saying that is that, paying your kids is another fabulous way to pay for college on the assumption that you're going to have them use the money for something related to college and they're actually going to do something for you. So that's the other one to be thinking about too, Trey. I found it hysterical again that my daughter sent me a post. Hey, I can't remember if it was TikTok or Instagram. It's one of the two. It's like, it's a girl that I follow. Look at the advice she gave me. You know about that? And I didn't want to go. Yes, honey. I actually have a Vault webinar on the topic. It's about 20 minutes long, explaining this very same principle. But by the way, for your ass, A, I already do. B, what are you gonna do for me?
Well, so two things. First, in-state tuition. I mean, you kind of made the assumption with App State. So yes, in-state tuition is awesome. Second, make sure you apply the FASB application, and more importantly, make sure you're monitoring that application process so you don't find out about 15 minutes before the deadline that there's a piece of information missing that you have to go dig for that is in my personal tax return that needs to be put into the data stream of that individual child's application. So those would be my two recommendations for newbie college parents.
Sounds like that's spoken out of direct experience, Jack. I don't know.
That was purely a hypothetical, purely a hypothetical.
Yeah.
As I roll my eyes, yes.
All right. So Trey says, thanks. I do pay him to clean carpet. Very good, Trey. That's instilling a good work ethic. Let's get both of them to go to app, and you can pay me rent, or we'll buy a new place together. Hey, could be a business opportunity for right there. So maybe we could be matchmaker right here. And if somebody else wants their kid to go to app, you guys connect with Trey Harb. So anyway, all right, we're hitting the fourth or third base. We're rounding to home. It's about 10 till almost. I don't know. This is weird. My computer is always 3 minutes ahead of every other smart device that I have. So my computer, which should be smart, is evidently not. So I don't know why. Another question that has come in: for farming operation, does a shop building constructed in 2022 qualify for Section 179 accelerated depreciation? Ooh.
So you're not in that scenario, kind of. So in real estate in general, what qualifies are leasehold improvements, which you kind of know what that's like, the drywall and everything that I did to upfit, everything on the interior. Assuming that that's not separately stated and it's all one building, what does qualify are the things that have to be replaced pretty quickly. So it's a lot of details, buddy, but generally speaking, I think with a shop building, assuming it's like a prefab metal building, about 50% of it is going to qualify for depreciation. So like what's not going to qualify is going to be the concrete pad, stuff like that. But generally, those things are bolted into the ground, so they in theory can be unbolted. So everything that it could be moved, even if you're never going to move it, is all stuff that's going to qualify for bonus depreciation.
So that
I'm
makes
totally impressed that you knew that answer off the top of your head, because I was kind of slinking down.
Yeah, no, we get asked that question all the time, because it's the same concept as in mini storage units, which is why mini storage units are pretty decent investments from what we've seen anyway, but it's the same concept that a mini storage unit, which we have a lot of clients that own those. They also have a fabulous tax benefit because, in theory, it's not a permanent structure. Anything that is not a permanent structure qualifies for accelerated depreciation.
great questions today. Love the variety.
Can I throw in the random fact of the day while we're waiting for the next question?
I hit it. Yeah.
Okay. So I accidentally found this as I was finding that other article that we talked about. So, there's always been, and I've lived in this community for almost 35 years. And so there's always been, since I remember from high school, the competition between the great state of Mecklenburg and Wake County, where our legislature, General Assembly sits, right? And so in the latest publication of the competition, it was this is my slant on it, who are the greater alcoholics, Mecklenburg County residents or Wake County residents? And so there is a publication that I found, and apparently it depends on your perspective. So if you're talking about just the amount of retail liquor sales in 2021, we in Mecklenburg County win, not by a large margin. So Wake County is right behind us. But then if you add in the sales at restaurants and bars, so mixed drinks and those kind of things, then Wake County actually beats us out. So apparently we drink more at home amongst social and maybe by ourselves. And in Wake County and Raleigh, they actually go out and have and drink and get drunk with other people in public. So that's my interpretation of the data. You're on mute. Gary, you're on mute.
Said, sorry. That's amazing. I don't know if it's more useful than your dumb dad jokes or not. I mean, they're kind of a toss-up. Trey, thank you. We appreciate you too. Nice comment. Enjoy lunch. All right, another question. Nope. That was Trey's comments of saying thank you. Well, last question for you guys, those that are still on. Hit us in the chat if there's something that you would like us to be dealing with in the next couple of weeks before we take a Christmas break or into next year. Just hit us in the chat real quick with any themes or, you know, topics that you want to have us address. So just let us know. Take us
Very
off.
quiet. Very quiet.
I know it's
crowd
very
today.
quiet, except
Mhm.
we've had some really good questions.
We have.
So it's been good. Aha. Robert, I knew I could count on you. New gap rules on leases. That is a great, because we are just dealing with that with a new client. Well, all right. Yeah, you know what we ought to do is we ought to have Carrie or Jeff or one of our audit partners join us in an upcoming thing. Don't you think, Adam?
I think he said yes. I saw his lips move.
Oh, yeah.
Realize that I was on mute. Yes, that would be great.
Okay. All right. Good one. Any other thoughts from webinar? Again, with regard to the chat, check out the article done by Shoemaker, Confessions of a Former IRS Agent. Make sure you register your DBA by December 1st. So that's today. Thanks for the heads up and for the forewarning, Jack. I mean, nothing like last minute.
Yeah, well, yes. Sorry.
Well, we were off last week for Thanksgiving, so, you know, I get it. All right. Last call. Any other questions or thoughts that you guys want us to hit us up? I'm going to call it here. Make sure you watch the soccer game on Saturday morning. Root on Team USA. Should be a good one. Our team in Netherlands kind of have similar style. We got a young team. So thank you, everybody, for taking time out of your day to join us. We appreciate it. Hopefully we're providing value to you. Thank you, Adam. Thank you, Jack. Sure appreciate it. Oh, here we got a question. Next session question: importance and value of having a line of credit for credit reporting, credit worthiness analysis, other reasons for value. Hey, you know, that's a great point, Bruce, because Adam, just the thought, we ought to have Joe Saley on here because he has expertise in helping businesses build business credit.
Yeah. Cool.
And I would say relatedly, since we're talking about teenagers and college students, that as far as building credit, a teenager, 17-year-old cannot get their own credit card. So typically it's the parent's credit card that they're an authorized user. Once they turn 18, they can get their own card. Obviously the credit limit is much lower, but it helps them build credit moving forward. And so I'm mentioning that to people as their kids come back home for Christmas break, to think about maybe, heading over to their banks and go ahead and getting that. And actually you can do a lot of it online these days, but it's something to consider, and something that I had forgotten about, because my kids have had credit cards for a while, since they were 16, so they could put gas in the car. And they're really my credit cards, mine and my wife's, which obviously, well, I shouldn't say obviously, they have a higher credit limit than would be granted to a 16-year-old. And so we're going to fix that. Not that we don't trust our kids, but we want them, it's not doing anything for their credit. It is building on my credit, not theirs. And so they need to be the primary card holder, and we would be the authorized user. So that way we could have access to those cards. So just something to consider, that just, again, randomly came up, but since we're talking about kids and credit, older kids, young adults and credit, something to think about.
Awesome. This was good. Thank you, everybody.
Cool.
Next week, 1:39. Be here, be square. Thank you for your time. Jack's always good to see you. Adam, same way.
All right.
Signing off. We'll put this up on the BGW CPA YouTube channel later on today. Take care now.
Awesome.
Thank
See
you
you
guys. Go US.
Bye-bye.
All right.